Since the 28th of February 2026, the global energy market has been paralyzed by the war in the Middle East. The Strait of Hormuz, which normally handles approximately 20% of global oil and 25% of global liquefied natural gas, has seen its vessel traffic drop by an estimated 90 to 95%. This represents the effective removal of roughly 21 million barrels of oil per day from the global market. And as a direct result of this disruption, Brent crude prices have surged past $112 a barrel, an 84% year-to-date increase. Analysts at Macquarie Group are actively warning that if this closure persists through the second quarter of 2026, Brent could easily reach between $150 and $200 per barrel. This disruption extends far beyond crude oil, however, severely impacting 30% of global seaborne fertilizer trade routes, as well as plastics, industrial glass, and broader petrochemical supply chains. To those with long memories, this might look a little bit like the 1970s Arab oil embargo all over again, a purely physical supply shock that will eventually be resolved through military intervention or diplomatic negotiation. Many assume that once the hostilities cease, the tankers will resume their routes and the legacy financial system will return to normal. But another story is playing out in the Middle East that's not about the price of crude oil, but rather the specific currency being mandated to purchase it. According to confirmed reports from the authoritative maritime intelligence publication Lloyd's List, at least 2 commercial vessels have already been forced to pay transit fees through the Strait of Hormuz using the Chinese yuan. Iran is aggressively fusing military geography with monetary strategy by enforcing a wartime parallel financial architecture directly at gunpoint. By demanding yuan settlements at the most strategically vital shipping lane on Earth, they are simultaneously evading Western sanctions and rewarding China as their primary economic sponsor. This is not some theoretical future threat to the global economy. It's a live operational bypass of the SWIFT network happening right now. And this localized monetary rebellion is just one small component of a massive structural shift orchestrated by the broader BRICS alliance in recent years. Nations across this powerful economic bloc have spent the last several years hoarding record amounts of physical gold while simultaneously dumping United States Treasury bonds. Central banks globally purchased approximately 863 tons of gold in 2025, maintaining a record-breaking accumulation pace that has pushed the BRICS collective holdings well past 6,000 tons. Meanwhile, countries like India, China, and France are aggressively repatriating their physical gold reserves back to domestic vaults to mitigate the risk of asset seizures. They watched the United States freeze approximately $300 billion in Russian sovereign assets back in 2022, and they immediately realized that holding dollar-denominated reserves was an existential threat to their own national security. Russia itself sold approximately 14 tons of physical gold from its reserves in January and February of 2026 alone to fund its budget deficit, demonstrating that gold is being used as an active operational reserve rather than just a passive holding. This realization has accelerated a massive bifurcation in the global oil market, explicitly splitting it into 2 competing pricing circuits and exposing a massive structural flaw in Western finance. The traditional dollar circuit remains intact for Atlantic Basin nations, Japan, and Australia, who remain steadfast allies of the existing financial order. But a rapidly expanding yuan circuit is absorbing massive energy flows from Iran, Russia, and Venezuela, routing growing volumes through China's cross-border interbank payment system instead of the Western-controlled SWIFT network. India is currently settling significant volumes of Russian oil, roughly 60 million barrels in March 2026 alone, by depositing rupees into overseas accounts that are then converted into UAE dirham or Chinese yuan. This creates a complex, multi-layered currency chain that completely circumvents the petrodollar hegemony and actively erodes the dollar's global reserve share. Recent data from the International Monetary Fund confirms this structural decline, showing that the United States dollar's global reserve shares has fallen from roughly 71% in the year 2000 to approximately 58% today. Furthermore, the yuan has actually strengthened by 4.85% against the dollar over the past 12 months, demonstrating an active currency appreciation strategy by Beijing. And speaking of tracking these massive macroeconomic shifts before they hit the mainstream headlines, this is exactly why you need the Coin Bureau weekly newsletter. That is where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so that you don't miss a beat. Whether it's a hidden clause in a newly proposed regulatory framework or a sudden spike in sovereign gold accumulation, our readers see it first. So sign up today using the link down below or by scanning the QR code on the screen. Now, let's return to the fundamental mathematics of the United States debt spiral. Because, well, the consequences of this de-dollarization trend are devastating for the everyday citizen. For decades, the artificial demand created by the petrodollar system allowed the United States government to seamlessly export its inflation to the rest of the world. Foreign oil exporters would earn billions of dollars and immediately recycle that capital back into the United States Treasury bonds, which artificially suppressed domestic interest rates and funded massive government deficits. But as foreign holdings of long-duration treasuries continue to decline, that traditional petrodollar recycling mechanism is breaking down, turning the dollar into a massive single point of failure for global trade. The TLT Exchange Traded Fund, which tracks 20-plus year United States treasuries, has dropped nearly 6% over the past year, signaling accelerated selling pressure from foreign holders. Macroeconomic research firm FFTT recently published a metric showing that the true interest expense of the United States government currently consumes approximately 96% of total tax receipts. This true interest expense calculation includes gross interest payments, mandatory entitlements, and veterans' benefits, painting a horrific picture of fiscal insolvency fueled by decades of regulatory capture. Let those numbers sink in for a moment, because they represent the mathematical breaking point where sovereign debasement becomes completely unavoidable. The United States is projected to require an $8 trillion liquidity injection between 2026 and 2027 simply to manage its overwhelming fiscal obligations. This forces the Federal Reserve into an impossible policy position that virtually guarantees persistent, deeply entrenched stagflation. The Fed has already cut its funds rates down to 3.64%, pausing the easing cycle precisely as Brent crude explodes higher. If they raise interest rates to fight this supply-side commodity inflation, they will bankrupt their own government by exploding the cost of servicing that massive national debt. If they lower interest rates to support economic growth, they will accelerate the debasement of the dollar and further incentivize foreign nations to abandon the petrodollar system entirely. Neither option resolves the fundamental problem, because supply chain inflation caused by physical energy disruption cannot be cured by demand-side monetary policy tools. When the world no longer needs dollars to buy energy because hostile nations are pricing crude in Yuan, well, the artificial demand for United States dollars evaporates. Oil exporters accumulate fewer dollars, treasury demand falls, and the United States government must raise yields to attract new buyers. Higher yields increase debt servicing costs, forcing the Fed to choose between catastrophic debt monetization and total fiscal collapse. Debt monetization requires massive money printing, which devalues the dollar further and creates an inescapable inflation feedback loop. This is the exact mechanism by which the end of the petrodollar becomes a severely inflationary event for every single holder of dollar-denominated savings. In a fractured, multipolar world, where trust between nation-states has completely evaporated, institutional capital is desperately searching for a lifeboat. The immediate beneficiary of this global panic has undeniably been physical gold, which has surged an incredible 42.6% over the last 12 months to reach over $4,490 per ounce, although it has fallen a long way from its recent highs. Meanwhile, the financial press has been quick to point out that Bitcoin has completely failed to act as a safe haven during this specific crisis, dropping roughly 19.5% year over year to trade around $66,500. The current data shows that Bitcoin is functioning primarily as a highly sensitive liquidity proxy rather than a reliable short-term geopolitical hedge. According to extensive research by macro analyst Lynn Alden, Bitcoin follows global M2 liquidity within an approximately 83% correlation over trailing 12-month periods. When global liquidity tightens due to the United States Treasury refilling its general account by issuing roughly $500 billion in bonds, Bitcoin's price is disproportionately impacted relative to traditional non-yielding safe havens. In a kinetic military conflict where physical shipping lanes are blocked and margin calls are triggered across global markets, institutional investors instinctively flee to the tangible scarcity of the 5,000-year-old physical metal. This is why gold and silver exchange-traded funds suffered nearly $11 billion in outflows in early March of 2026, while institutional investors desperately reallocated capital towards physical delivery. But while gold is winning the short-term debasement trade, it suffers from a massive structural flaw that makes it entirely unsuited to serve as the base layer for a modernized digital economy. Gold is physical, inherently slow to transport, incredibly expensive to secure, and incredibly easy for hostile governments to confiscate or sanction. This is precisely why sanctioned nation-states are turning to cryptographic settlement layers to completely bypass Western financial blockades. In October 2025, the Russian Ministry of Finance officially authorized the use of Bitcoin for foreign trade settlements, completely reversing their previous domestic bans on cryptocurrency. Russia now commands approximately 16% of the world's Bitcoin hash rate across nearly 197,000 mining farms, transforming cryptocurrency mining into a strategic national export industry. They have developed a dual-track crypto settlement system that facilitated approximately 1 trillion rubles in trade volume in 2025, moving tens of millions of dollars monthly between Russia and Chinese intermediaries. Furthermore, total illicit cryptocurrency transaction volume linked to sanctioned state entities reached $104 billion in 2025, representing a massive 694% year-over-year surge. While 84% of that specific volume used stablecoins rather than Bitcoin, it definitely proves that sovereign actors are aggressively adopting decentralized rails for commercial contract execution. Russia even developed a ruble-backed stablecoin known as A7A5, which processed $93.3 billion in transactions in less than 1 year. Elsewhere, following the onset of the current conflict in late February, Iranian cryptocurrency outflows from domestic platforms like Novitex jumped by approximately 700%. This massive capital flight demonstrates exactly how Bitcoin serves as an apolitical wealth preservation tool for ordinary citizens when traditional banking infrastructure is entirely weaponized or destroyed by the surveillance state. Even nations like Bolivia have officially announced plans to use cryptocurrency to pay for imported electricity, establishing a documented precedent for cross-border energy trade settlements on a digital ledger. Despite the short-term price underperformance, institutional adoption of Bitcoin continues to accelerate behind the scenes. BlackRock's IBIT exchange-traded fund has accumulated approximately $63.2 billion in cumulative inflows, making it one of the most successful ETF launches in financial history. BlackRock alone now holds roughly 785,000 Bitcoin, representing approximately 3.7% of the total possible supply ever to exist, secured within a single institutional fund. Meanwhile, the United States government itself holds over 328,000 Bitcoin in its strategic Bitcoin reserve, although that reserve currently acts as a passive holding mechanism for seized assets rather than an active treasury strategy. The mining economics are also flashing warning signs, with the weighted average cash cost to produce 1 Bitcoin currently sitting at approximately $79,995, forcing miners to produce at a significant loss relative to the current market price. This structural capitulation is forcing mining companies to pivot their infrastructure capacity towards AI and high-performance computing to offset their mounting losses. So, what is the ultimate conclusion that we must draw from this unprecedented collision of geopolitical conflict and macroeconomic fragility? Well, on one hand, we must acknowledge the uncomfortable truth that Bitcoin has significantly underperformed physical gold during this acute physical supply shock. The digital scarcity of Bitcoin cannot physically fuel a cargo ship, and its current price action remains heavily tethered to the expansion and contraction of global fiat liquidity. But on the other hand, the structural properties of a decentralized, mathematically provable settlement network offer a permanent solution to the weaponization of fiat currency. Unlike physical gold or heavily regulated stablecoins, Bitcoin provides a 24/7, borderless, censorship-resistant transfer mechanism that requires absolutely no permission from any traditional banking cartel or fractional reserve banking system. So, the closure of the Strait of Hormuz and the aggressive push for Yuan-denominated oil trades are the undeniable death knell of the petrodollar hegemony. As the global economy fractures into competing economic blocs and central banks prepare to inject trillions of dollars in fresh liquidity to monetize unpayable sovereign debts, the ultimate value of absolute digital scarcity will become impossible to ignore. Holding a non-state asset that cannot be debased, frozen, or confiscated is just no longer a speculative technology play. It is an absolute macroeconomic necessity for preserving your wealth in the coming decade. But what do you think? Will the United States dollar maintain its global dominance, or are we witnessing the birth of a new multipolar financial system? Let me know your thoughts in the comments below. And if you want to understand how the Federal Reserve is quietly losing its independence, well, then you can check our video on that right over here. And if you want to dive deeper into how institutional exchange-traded fund flows are impacting Bitcoin's base layer, well, you can check out our video on that right over here. Thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.